All businesses need adequate working capital and specifically cash to be able to trade. If a business does not have adequate working capital, it will not be able to invest in its growth and will be at risk of not being able to pay its debts as they fall due. It may become insolvent and be forced into liquidation. What is working capital and what is an adequate amount for it to hold? The working capital of a company is defined as its stock plus debtors plus cash less its creditors falling due within 1 year. It is the net sum of its trading assets and liabilities. Stock is not a very liquid asset. It takes time to be converted into cash through the production and sales cycles. It is therefore often discounted when considering the adequacy of working capital. A common ratio used in considering the adequacy of working capital is to consider the quick ratio. This ratio is calculated as the sum of the debtors and cash of the business divided by the creditors falling due in less than 1 year. Different businesses will require different levels of working capital. However, generally, a safe minimum level of working capital is one that gives a quick ratio of 2. Working capital is funded from the following sources: retained profits, loans from proprietors and their families, share capital, invoice financing, bank overdrafts. Since the financial crisis of 2008, the banks have very little appetite to fund working capital by providing overdrafts. The funding offered by the banks now tends to be invoice financing, either through invoice discounting or invoice factoring. There is strong evidence that small businesses are very wary of obtaining working capital financing from banks and are using loans from proprietors or retained profits. Hollingdale Pooley can advise businesses on the level of working capital that they should hold and how this finance can be obtained.